Good morning to everybody. Thank you for joining the conference call. I'm sure you received the presentation we have sent this morning. Filippo Lanza, Portfolio Manager of Edge Invest Newman Credit Fund, will use this presentation to update his view. And at the end of the conference call, there will be the possibility to pose the questions to Filippo. So now I would like to hand over to Filippo. Thank you, Filippo, for your time. Please go ahead. Thank you.
Thank you, Stefano, and good morning, everybody. This is Filippo Lanza, the Portfolio Manager of Edge Invest Newman Credit Fund. We're taking this opportunity to discuss with you the key opportunity set that we see for the remainder of the year and 2018. The first slide is just giving a quick summary, and then we'll enter into some more specific names and trade ideas we've involved at the moment, and we intend to go a little bit more in depth there, and then we'll open up to a Q&A session at the end. At the moment, if we look at the banking sector, it's quite an active sector for us. It's been probably the most profitable contributor for us this year, especially with regard to bank credit. We're quite constructive on the bank credit. We think there is an ongoing, almost relentless value transfer moving from equity holders to bond holders, a lot under the pressure of the regulators, which obviously is reacting or overreacting, like some may say, to the big crisis that we had during the financial crisis in 2007, 2008. At the same time, we see a continuous strong demand for NPL assets, and this is across countries. We're seeing a booming demand in Italy now, but has been as such in Spain for the last couple of years. So with that in mind, obviously the balance sheet is improving quite a bit, and the quality of the bank issuer has been improving, on top of also having banks issuing non-preferred seniors, always under the pressure from regulators. We think this is very good for credit. Obviously, there is one big caveat, which is interest rates. A lot of the deeply subordinated credit exposure issued by banks are quite exposed to duration, number one, and number two, they are quite structured, so that even if somebody wanted, it would not be possible to hedge interest rate risk and volatility. So we trying to structure our book in a way to minimize interest rate exposure, and obviously we've been quite actively also using credit for swaps as a way to vehicle our bullish views, and at the same time trying to be very wary of interest rate sensitivity within the group. Now, credit also is great, and banks in general for capital structure arb, special situation events. We've been quite active there, with Banco Popular probably being the best name this year. We think there's going to be more opportunity like that, so credit remains a big area of focus. But having said that, we think we're getting ready for the moment where bank equity is probably going to be the most compelling trade out there. Like we said, balance sheet is improving substantially and quite consistently across countries, across banks. But at the same time, we think we're not far away from the moment where income statement as well start showing some good signs of recovery. So far, and it is quite generalized comment, but it holds relatively true, most of the banks are struggling on the income statement, on the income generation, because the spread is quite low, and that's very much a function of interest rate. So you need to have a view on the directionality of rates, and we are quite confident rates are on the way up, especially in Europe, not just because the macro drivers, which we think are very strong, but also because it's a corporate governance issue. The ECB has been supplementing the role of government for a long time. The corporate governance rules and toolbox have been set up and established in a very nice, very articulated way. So ECB role will be diminishing no matter what over the next few years. So they will rely more on forward guidance, more on interest rate levers, rather than pure balance sheet expansion. So what we expect on the bank equity side, we think rates may be a good driver, but at the same time, we think there's been a lot of cost cutting, there's a lot of cleaning up of the balance sheet, so pre-provision loss provisioning will be reduced. We think there is an enormous amount of value in some of the franchises. We think technology is reducing costs for some of them. It's one of the few sectors actually enjoying technology at the moment rather than being a victim. So we think there is quite a bit of activity there, and so we like equity prospectively into next year, and that's why, for example, we still like very much some of the positioning, some of the bank equity on the periphery that will be exposed by the restructuring, such as Monte dei Paschi. One big driver, obviously, that we see for next year, as we said before, the corporate governance for sovereign issues has been happening in Europe, but at the same time, the banking union has been progressing. And one of the key items of the banking union that still needs to be developed is consolidation across countries, consolidation across regions. We've seen quite a few big transactions in banking this year. We've seen Banco Santander buying effectively the entire balance sheet of Banco Popular after the restructuring, and we've seen Intesa doing it with Veneto Vicenza. We recently seen Deutsche Bank and Commerzbank being the target of some minority stake built up by a big activist investor. So we think the consolidation wave is not far away. We think regulators are really going to push for that. So we think there is big opportunity there. There's a lot of little banks with a lot of DTA, deferred tax assets, which are quite attractive, especially if you think your profitability is improving. And the price book valuation discrepancies across different banks are so much that for the acquirer, the acquisition itself pay itself in the sense of both via DTA and both via the goodwill and capital available for the cleanup. So on the bank side, to summarize, quite constructive on credit now, although very wary of interest rate sensitivity. And going forward into next year, we are building and looking at expand our relative value market neutral positioning on bank equity. And obviously with a very keen interest, although cautious, on some of the periphery banks. Away from that, if we move into corporate, I think corporate is probably the most exciting sector right now going forward. Eventually this month we start seeing the first cracks in the credit market, so we're really excited about it. We think we are overdue for a very significant correction. Now, we don't think the correction is going to come just because of valuation. We don't think correction is going to come just because of interest rate, although those are very meaningful drivers. Don't take me wrong. I think valuation will be there. I think the liquidities that's been created by the central banks buying and everything else has been extreme, and that's been decreased. So that could trigger valuation repricing. There is also an issue of a lot of over-levered, overvalued capital structure. Companies some people like to call zombies, and there is plenty in the credit market especially. Credit market is always a subset of the bad companies. Companies that are good and big in equity market, they tend to be good companies because they've got big equity valuation. Not always, but most of the times. Credit companies typically are there because they had to build debt. And we've seen a massive build-up in debt. Sorry, we had a fire alarm drill here. Apologies. But like I was saying, on the corporate side, we think there's a lot of companies that are over-levered, overvalued. A lot of those capital structures have been effectively limping along for the last couple of years just because the credit market was always reopening for them to refinance. But that could change, obviously, if interest rate going up. The most important thing for us, to paraphrase Warren Buffett, is to look at the moats, the competitive moats around the corporate fortresses. A lot of those competitive moats have been totally dried up by the technological wave coming up. Levered media, telco, retail are definitely there for massive reckoning, and we are really focusing on those names as the best short opportunity for next years. we've seen for the first time this month, perfect example has been Altis, like a darling of the credit market, a darling of the equity market. They lost 50% of the market cap, and the market cap is now 50% of the total capitalization of debt. Capitalization of debt, which let's not forget, in Europe is effectively benchmarked to Bund. So whatever credit spread you have is sort of being more than offset by negative rates in Bund in order to get to the final pricing. So the valuation are totally wrong. There is a very big opportunity there. And if I look at Altis, is a perfect example. They are distributor of content in a market where distribution is being destroyed by technology, because you can have Netflix doing streaming online. You don't need cable anymore, not necessarily. You don't need telco anymore, not necessarily. Or at least if you need them, you don't need to pay them that much. They're an intermediary. They're a broker in between. And they are getting squeezed and squeezed and squeezed. At the same time, content is trading more and more of a premium. Even over the last 24 hours, there was more speculation about Fox assets being put on sale and everybody looking at them, because content is really where the value is going. Now, the problem for a lot of those sectors, and I'll give you the example of the telco media because it's the most striking to me, but retail, logistics, there's plenty of others. Telco medias are sectors that have been levering up over the last 20, 30 years, consistently and continually. Now, the biggest problem for them, think about guys like Altis or Comcast or anyone out there, is that all of a sudden they are meeting the competition coming from the most scary corporation around the world. Because if you look at telco now or media, you now have competition from Apple with their Apple TV. You have competition from Amazon with Amazon Prime or Amazon Fire TV, and you then have competition from Netflix. You then have competition from Google with YouTube, and you have competition from Facebook with their TV time. Now, just look at how your kids consume TV, and that's going to give you a very, very scary expectation about any satellite providers, whether it's Biscabee, whether it's ProSieben, any other traditional telco media operators. That sector is becoming outrageously competitive, and that's without even thinking about Google or Amazon or Facebook building their own infrastructure for distribution of content. So now the interesting thing for us, which are good old-fashioned credit guys, is that there are trillions and trillions of debt in those sectors. And those trillions of debt are based on the assumption of predictable cash flows, which will become very unpredictable going forward. Just look at the growth of Netflix. They ended up with 110 million customers globally in a very, very fast period of time. So we are really focused on this sector. We really think that it doesn't matter whether rates go up or down now. It doesn't really matter anymore. Some of those sectors are in for the reckoning, whether it's Rite Aid in retail, whether it's media, telco, logistics. There is a lot of sectors who are super, super levered. And unless the market is there to help them, they will have a real issue. But the issue is going to come anyhow through the quarterly earnings, because we do think the competitive pressure is going to start coming up. And our strong view is that the speed at which this movement is happening is absolutely incredible. Now, that opens up, in a way, is actually linked and is a function of the next big opportunity we see on number 4, which is we see a lot of interesting opportunities in corporate M&A. As you know, we always approach them from a credit angle. But just to give you an idea, obviously, we're not the only guy seeing these movements. I mean, the corporate officers see them way better than us. And if you look at what's happening, for example, in the media telco sector with Vivendi looking at Mediaset in Italy, with AT&T trying to buy Time Warner, with now recently speculation about both Comcast and Walt Disney looking at Fox assets, there is clearly a lot of consolidation being triggered by this move. People are going to try to defend themselves from this technological wave. Now, the beauty of it is most of this defense action are actually, because of the credit market now, are going to be funded 100% in cash and funded by the credit market. So for us, we're very prepared to look at this stuff also from a corporate M&A event side, but always using a credit angle. Obviously, we're quite involved with Biscabee. We're involved with AT&T, Time Warner, and the view, and we actually involve also with Altis. Always with a credit angle, credit and equity, and our view on most of the sectors that, frankly, it doesn't really matter where you are. the competition is going up to a level. There's going to be a big credit repricing coming up. Away from the tech impacted, there is plenty of other names which are ongoing corporate M&A as a function of low rates and cost of funding. We've been involved with Monsanto, with Abertis, with NXP, Qualcomm. There is plenty of other situations. Now, one very interesting that we can talk of, which is actually opening up the opportunity, which is number 5. There's a lot of the old technology sector which have been leveling up themselves over the years, whether it is Apple, IBM, Cisco, NXP. All these guys have been accessing the credit market more and more. But what we see now, we're also seeing within the corporate M&A, we're seeing a lot of that is being consumed in technology-intensive sectors. One perfect example is chip makers or chip designers, to be exact. And if one look at the Qualcomm bidding NXP transaction, that is 100% going to be financed in cash. And then if one look at Broadcom, looking at buying Qualcomm and being happy to also be buying NXPI at the same time, then you're looking at another transaction which is 100% funded in cash. Now, those companies are technology companies. They're trading a multiple of revenue. So they're not our traditional credit company, which trades typically at best at 1 times revenue because they're over-levered, they're in a kind of mature sector. Those companies actually trade at a multiple revenue. So the moment you buy them in cash, you're crystallizing a revenue multiple of sometimes 4, sometimes 6 times, which then means no matter how good your EBITDA margins are, you're still going to create a massive amount of leverage. Just to give you a sense, if Broadcom is going to consume the Qualcomm and XPI transaction, we're talking about 150 billion of financing, which could be trading anywhere between 4 to 6 times EBITDA. Now, the expectation the EBITDA is going to grow, the margin is going to be healthy, but it's also a very competitive sector, very, very, very volatile. So we're also looking at that sector, which typically is a sector where the equity investors and the equity analysts are very, very strong, and credit guys typically haven't really looked at it because there's no much point spending time on the credit of Apple when they got cash balances of that amount. But the reality is that the technological wave is happening both for mature sector but also for technology sector. So we see a lot of volatility, and we see credit as being a very, very cheap tool to a very levered position on some of the TMT changes that we see coming. We are involved with NXP, Qualcomm, Broadcom, and we think it will be a very defining moment. And we're expecting a lot more M&A activity, especially if the tax deal, in the United States is gonna come to life after Thanksgiving. Last but not least, obviously, is the macro opportunities. I know it's a bit of a refrain, this one, because we keep on talking about it, and I think like us, many others. The macro opportunities I think they're here to emerge in 2018. We've been very opportunistic on that, and we've already been trying an entry point to be really short Govie in Europe. That has not come to fruition. As you know, we've been developing both systematic signals via the software we develop and the company we bought on social media. But at the same time, we've been relying on our fundamental research for this opportunity and to find the timing and the sizing. So far, this year hasn't made money. If anything, it's probably the biggest loss maker this year, especially with UK Brexit positioning. But we do see that as a massive driver for the next 12 months. Like I said before, there is a big macro fundamental driver here, which is growth is improving, inflation is picking up, the Phillips curve is really being stretched, not only in US, but especially in Europe. One look at Germany labor market, one look at Eastern Europe labor market. But that is very meaningful, and one look at the spread between US Treasury and Bund, it just doesn't make any fundamental sense. But more importantly for me, the real difference in Europe is that we came into S&P, OMT, QE, and all this stuff obtorto collo because ECB decided, especially under the leadership of Draghi, which is quite an exceptional character, which I doubt we will see again in terms of abilities on the ECB Council ever. But the ECB has been coming into those as a way to supplement governments. The governments were inactive, and that's what they've been telling us for the last years. The governments are not ready, they can't do this, they can't do that. Now, if one look at what happened, Europe now has a clear corporate governance framework. They created the ESM, and DSM has voting rules and decision-making rules which are totally German-centric. Germany and France have effectively the ability to decide whatever they want, and Germany's got veto power. Is very, very different from corporate governance in any other European institution and European monetary institution. Is the opposite of what is going on at the ECB level. That means that the corporate governance toolbox is set up and is ready to be used. And people sometimes tend to forget that over the last 3 or 4 years, we've been issuing only government bonds with caps attached. Is not far away in the future, the moment when Italy or Spain or Portugal will have the majority of their bonds which are caps regulated. That's impressive. So what we had with Greece in 2012, we will never have it again. We will have a different thing. We'll have a permutation of many more things, but for sure, the rules that have been established to the ESM will happen. So all of a sudden in Europe, we'll have a situation where the ECB is withdrawing the stimulus because of macro drivers. But at the same time, what has been going on in the background is this new corporate governance set of rules, which is emerging and is going to be ready to be used. So all of a sudden, it could be 2018, it could be 2020, if and when a government is going to need something, I don't think the ECB will ever be there with a QE probably, but the new rules of the ESM will be there, and the market will start discounting them well in advance. Hopefully, the base case is that next year when the ECB removes the stimulus, we'll have a situation where the growth in Europe is still very strong. So rates in absolute terms will go up, but the spread between different countries will stay the same, if not even tighten. But that's something that we need to be very, very wary, because we could be in a situation where that doesn't happen, and I think we would have a very different pricing of periphery risk, especially government bonds. Now, having said that, one last word of warning on the ECB side is that the ECB is also incredibly restricted and inflexible in terms of their mandate. They only have inflation. Now, if I look at the labor market, or I look at the oil complex, or I look at the situation in Asia, it looks that this synchronized growth is here to stay, and also there's plenty of geopolitical risk. Venezuela on itself produced 2 million barrels a day. If they're really going, as I expect, into a disorderly and chaotic default with restructuring far away, I think that will impair the oil production. So if we put all these things together, there is a probability of a scenario where inflation goes above or at 2% next year in the first 6 months. And whatever the ECB commitment has been, the ECB commitment will be revised. ECB is only going to do what they can do, what they said they're going to do, if the data afford them to allow them to do it. So whatever central bank policy statement forward, any forward guidance is tautological, which means it's only going to be there if the data is there to allow them to do. So I wouldn't be surprised of a potential shock event over the next 6 months. Now, I spent a little bit more time on the first page because I really want to share with you the way we're looking at banks, corporates, and Gobi. It is incredibly exciting for me. I mean, this month with Astaldi and Altice, we had the first feeling that the cracks are coming up. So a lot of the position we've been working and building is coming to fruition. I think the banks is another thing that's going to come to fruition. And obviously the most scalable opportunity is going to be on the Gobi side, which I think, again, we're not far away for very fundamental reasons behind the market. I'm just moving quickly to some of the trade examples. We have half of the call available for that. The first example is Rite Aid, post the failed merger. Rite Aid has entered into discussion with Walgreens. Just to give you a sense, Walgreens initially made an offer for those guys at $9 shares. Then the offer got revisited down to $6, and then eventually they bought some of their assets with the equivalent of a $2.50 per share. That's very important because it gives you the perspective of how fast the deterioration in some of those sectors is going. The deterioration is massive, and it's not just Amazon. It's also guys like Walmart. Walmart is probably going to be as good as Amazon this Christmas season in terms of their online sales and growth there. Now, if you're a small guy like Rite Aid and you have not invested, there's going to be a new guy coming with new technological solution. They are effectively e-commerce, simple as that. They are literally going to drive up your moat. But you have a capital structure which is coming from the 90s. And that capital structure is way too heavy for the cash flow you're going to produce. So when we have Rite Aid, for example, we look at Rite Aid, and this is a company which is still alive on the expectation they're going to get cash from Walgreens for the sale of their asset. And they should be getting something as big as $4.37 billion in cash. Now, there is quite a few risks to the sale being completed, but even if we avoid considering them and attaching any probability, our strong view is that the operating profitability of these guys is going to decrease substantially and is going to continue the negative trend. So whatever the cash injection from potential sales is going to come, we think it will be only used to pay out the banks, or even more likely, if their competitive position deteriorates faster, is going to be changed into some sort of repackaged bankruptcy, Chapter 11. Now, there's been a lot of speculation about Amazon entering the sector, which is obviously terrifying for guys like Rite Aid because it will be the end of it. But at the same time, it's positive because people may think Amazon is going to buy them. Now, that's where the credit angle kicks in for us, because the good thing about credit, in a way, is that it's quite more articulated than equity. So equity is just one single stock, nothing more. So you can either be long or short or do options around it. But when it comes down to credit, we have an exposure that is quite continuous. It goes from CDS, can be any point until 10 years, and then we have bonds that can go anywhere from 0 to 20, 30 years. So, for example, in the case of Rite Aid, we are positioned with a big short in the next 3 years, which is where we think Rite Aid effectively will have to deal with the current capital structure, which is untenable. But at the same time, we bought long-dated bonds, which are trading quite distressed, into this 65 to 80 kind of range. But those bonds are very long dated, and because they're prospectus, they basically have make or calls. So in the case Amazon come and buy them, we would make some money. Obviously, we make a lot more money if they go into Chapter 11. But because the credit gives you this richness of security to kind of articulate your position, we can actually fine-tune and optimize the position. So Rite Aid is something which is quite big for us. We think is something that's going to work out in the next 3 or 4 months, and it could be quite spectacular if it happens the way we think. What we are absolutely certain is that the deterioration in the market is massive, and we have no doubt to think that Amazon eventually is going to come into that sector, or via acquisition or via internal growth. Doesn't really matter anymore. And again, it's not just Amazon. Walmart themselves have been building pharmacies inside their stores, and they are going to effectively use that for their offering online as well. Let me move to the next one, which is the Rite Aid graph, and we put it there just so you see the CDS, the way it's been moving. European financials, I think we spoke quite at length on that before. Obviously, the big drivers now is the relentless push from ECB, SSM on cutting an NPE and using the capital markets to effectively restructure. Banking union is quite established. There are a few bits and pieces missing, most importantly deposit insurance, but that's only going to be done once the banks are all clean up. And I think it's pretty clear the map that the regulators have in mind. And so they're really pushing hard for the NPE cleanup. I think we cannot underestimate the ability of regulators that with Banco Popular, when they effectively resolved the bank and sold it to Santander within 24 hours. That's something which is quite impressive, because I think that sort of corporate governance is what we will see potentially, or that's the kind of template they're looking for governments going forward. Now, with that in mind, obviously there is the next target of regulators is to create or to push and support and in a way incentivize cross-country or intra-country mergers and acquisitions. So we do think there's going to be plenty of M&A activity there. Credit, as we said, we need to be very cautious on the interest rate sensitivity, but overall, credit will remain positive now, and we like very much, either direction long on credit or capital structure across. On equity, we think is going to be the trade of next year, potentially. There is time. We don't need to be in a rush, and we can do it as simply as via the index on bank index or via equity on specific banks. On our portfolio on equity on the banks, which is doing very well this year, is strictly a market neutral positioning. So we always either relative value one bank versus the other or fully hedge versus the index. Specifically, one example that we gave on the following page is the position we had both in credit and equity on the Spanish banks, both Liberbank and Unicaja, which we've been positioning on the equity side versus Bankia, and on the credit side, we've been trading them, especially Liberbank, from an outright long. Initially was a short into the Banco Popular resolution, and then eventually we turned into a long under the expectation the capital increase would have been successful, and it was concluded very successfully in the last couple of days. We like Spain because Spain is quite accelerate at a very advanced stage in their restructuring. There's been very active market in NPL and troubled assets from the banks, foreclosed assets. The judiciary system there is quite efficient, so we've seen a very decent cleanup there. We also see quite a bit of cost cutting. Cost cutting is quite feasible on the Spanish bank, so is a sector where we think will probably be the first region where we can see a decent wave of consolidation coming up. In a way, we've seen with Santander, Banco Popular, which is also sort of raising issue for the other players domestically to kind of consolidate because it's changing the relative sizing of different banks. One short we like is Bankia, partially because it's very much a government-owned entity, 65% owned, and we think the valuation is very, very stretched. The interesting thing about the Spanish banking system also is the cost synergies can be quite relevant given the labor market rules. So we do think both Liberbank and Unicaja would be effectively targets rather than consolidators, but they could be good targets, and I think it will be very beneficial for both credit and equity in terms of valuation. While we see Bankia quite full and probably the short of choice in case the Catalonia situation becomes complicated again. On that, as a quick digression, we remain relatively positive. We don't think we're going to see a deterioration of the political picture. We think it will be volatility and concerns in the market, especially ahead of the vote this December. But overall, we think it's something that is going to effectively end up into a non-event with possibly the non-secessionist forces winning the majority in parliament at the end of the month. On the following page is on the relative value between Liberbank, Unicaja, Bankia, which our banking analyst has prepared. I'll leave it for your reading at a later stage in order to preserve the time. I'm just moving to slide 8, is regarding Astaldi. Astaldi is an interesting story for us. It's a name that we've been trying to short many times in the past, both credit and equity. We actually just hired a senior credit analyst, which had a very strong view on Astaldi on the negative side. It just came as this thing was unfolding, so we managed to short both credit and equity, not as big as we would have liked because it already started to move. But Astaldi is the perfect example of the current credit market. It is a company which is very, very levered. They have, we think, a capital structure which at the moment is untenable. They're trying to launch a rescue issue for 200 million euro, which we think will barely enough to buy time. Their EBIT margins are under pressure. They also have a very big exposure to emerging markets. Emerging markets is the other complacent trade that we see out there. We don't need to go and short specific emerging market countries. We can just look at companies we're very exposed to them, especially countries we are very negative on, like Turkey, like Venezuela. There are markets where there are a lot of companies in Europe who are quite exposed to both. Astaldi is one of them. That's one of the reasons why we are not positive. There's been a recent bounce. We've been trading opportunistically, but we think this thing is a name that we will have to deal with. Now, this is a classic example where because they were in emerging markets, everybody loved emerging markets, because credit was strong and nobody dared to short anything, and retail was really strong in Italy, these bonds have been trading at very, very overvalued levels. Same for equity. But eventually, when the earnings come out, the data is going to show. And if Venezuela is about to get into default, obviously these guys have to take down their Venezuelan exposure. Turkey is another name where we are very, very negative as a country. We think there's going to be plenty of problems coming from there. So it's a theme for us to look for companies with exposure to those markets and look at them, especially when they're overvalued, and look for shorts. Now, the interesting thing on Astaldi, like similarly to Altice, is that this is the month where for the first time we've seen the credit market losing a little bit of patience. I mean, Altice is incredible as an example because we're talking about a company with 50 billion market cap of debt and 25 billion now of equity, where the equity literally melted 50%. And it's a company, like I said before, they're a broker, they're an intermediary. They don't produce any content, just distribute it. And distribution of content going forward is not going to be that profitable. It's going to be super competitive, while content is going to keep on going up. So I'll just give, the next one is the charts on Astaldi. It just give you a sense of the speed, of the violence of the move. The equity collapsed literally almost 50% in a couple of days, and the CDS went up almost like from few points up front to something like 50 points up front. Just to give an idea, if you look at the equity price, we've been putting shorts on the equity from time to time at around the 5.5, 6 level, only most of the time to just being trigger on our risk management calls and reduce the position because the stock was going up. This is a good reminder for us because I think for the first time we see that it doesn't matter how strong the credit market, it doesn't matter how much ECB is buying, when the earnings are coming and the exposure are there, the realities start kicking in. So the next slide is the one on the technology stack. We just hired an industry veteran which has been around for 20 years on the TMT sector, and he comes from an M&A background, which obviously is perfect given the level of M&A activity we see coming, but is also very good because he's deeply fundamentally driven. He looks at the product first, and then the balance sheet, and then eventually the valuation in credit and equity, which is where we come in. Now, like I said before, there is a big wave of changes, and those are affecting a lot of the traditional industrial sector we are exposed in the credit market, but it's also coming through technology companies. What is interesting about those technology companies is that they are relying increasingly on the debt market to refinance their acquisition, and that's a big change we have not seen. This is the first time, I think, where the technology sector is so leveraged on a relative basis compared to the past, and that is a new variable that has to be considered going forward. Now, we specifically to Qualcomm and XPI, when Qualcomm made a bid for an XPI, we started a merger arb position. We got long an XPI shares, and we used credit to partially hedge. We saw several merger arbs coming in, especially Elliott, which is quite a vocal activist. And as they came in and the shares started trading at a premium to the offer, we started reducing a little bit the position. Then we initiated a value-driven long on Qualcomm versus NASDAQ because we thought it was completely overblown, and it was probably the best in class chip design maker for mobile entity. And we were vindicated when Broadcom approached them with the buy. We think that this sector is absolutely in play. There's probably going to be even more acquisition. We think Intel is a little bit the dinosaur here, which may be using his cash to acquire those companies. And what is interesting is that if the Broadcom, Qualcomm, and XPI transaction is consumed, that will be financed with 150 billion of that, which typically will not hit the market immediately, but it will hit the market only halfway through the regulatory process and halfway through the shareholders process, which basically means that all this merger and acquisition we see now, eventually they will create a forward supply in 5 or 6 months time. Now, and as I said, the very interesting point here is because they're technology companies that trade a massive premium, massive multiple of revenue, 4, 5, 7, and the moment you buy them with debt, you're effectively crystallizing that valuation, and you're relying then the debt servicing on the cash flow. The next slide is just simply the stock price of an XPI and Qualcomm. We still have position there, and we actively use credit or if it's equity, it's always market neutral. If it's credit, we're trying to also add the credit angle to optimize the position. And we think this sector has to be monitored because it will be a big, very active play in credit. The next page is dedicated to our never-ending saga of Banca Monte dei Paschi di Siena. I can only apologize because our timing was wrong last year. I think we were a bit surprised by the regulators not giving them an extension, but obviously that probably was because they had to focus on Veneto Vicenza, and that's our ultimate explanation ex post. The current Paschi has been relisted this month. We've been reducing a little bit of position as it went up above the 475 print. We reduced a little bit of position, but we are looking at it very tactically. Within the bank as of now, the equity has been very volatile because obviously we're concerned about Carige, concerned about Credito Valtellinese, and obviously there was this story about these MPL and MP new rules on the old stock of MPL and the new stock of MPL. But that position has been obviously very volatile in the last month, so we suffer a little bit on that. But the valuation we are seeing now is incredibly compelling. Within this stock can literally double from here over the next few months for a variety of reasons, not just macro consolidation, speculation, but also just because the valuation is incredibly cheap. We tried to prepare a slide, the following one, where we go through all the valuation. Our banking analyst is available to go through in details, but basically Monte dei Paschi is one of the cleanest banks around. There is a booming market for MPL in Italy. Most MPL sales are effectively auctions, and with a very long list of buyers. So we think from a balance sheet point of view, the bank is very clean. If you just look at the balance sheet, it should be trading probably above 6 already. The issue and the big question mark is the income statement. Is the bank going to be able to be profitable or not? Obviously, a lot, as for every other bank in Europe, depends on rates. So Paschi is effectively a very, very in-the-money call on interest rate going up. Now, the franchise has been relatively untouched. No matter how much stress they went through, the franchise is there, and we think now in the normalized environment they will probably be able to produce good results and surprising results. The bank still has some unlikely to pay, but basically have no NPL right now. It's probably one of the few banks that can say they do not have any NPL. They have unlikely to pay, and we think the bank will enter into new transaction going forward. They already taken the entire IFRS 9. So even taking the entire IFRS 9 into consideration and all the other adjustments they may have to do, and Paschi is being incredibly conservative versus many other banks that look like in denial on IFRS 9, it's difficult to go below 9 billion as a tangible book value for the bank. And that doesn't include DTA, which are in excess of 2 billion. So you're talking about something where the TNAV, it could be close anywhere between 9 to 10 euro, and is now trading at 3.5. Now, it's been difficult, and obviously we need to find marginal buyers and probably new buyers, but at the same time, the technical conditions are amazing because the bank free float is ridiculously low, and if anyone could buy them now, they would get half the money from their DTA in the company that then obviously will become available for fruition. Okay, I'm not quite sure where I lost you guys, but just to conclude on Paschi, as I said, difficult to get to a tangible book value below 9 billion, and that's without considering 2+ billion of DTA. So at the moment, we own around 2% of the fund is in there at 3.4 euro roughly, which is where it is now. We think it's incredibly cheap. We think it will be part of consolidation. We think it will probably surprise on the franchise ability to still generate revenues and income. And obviously is a very big macro call, embedded call into the stock price, obviously on rates going up and the Italian economy continuing, which we definitely see, and the NPL market booming. And I don't see anything going against that sort of trend. I am moving to page 14 of the presentation. We're just talking about Sweden now. It's we've been obviously very much following the NPL market across Europe, and because of that, obviously we started looking at Intrum, the company previously known as Intrum Justitia, which is the largest debt servicing and purchasing company in Europe. They recently merged with Lindorf in a very smart move. Their EBITDA is very strong with a very good growth prospect. Obviously, the European Commission mandated them some remedies. So this originated as a mix between financial analysis and event kind of analysis of the picture. They have been reducing some of their assets, and they're selling them at pretty good levels. We like both the equity and the credit. The equity, as always, we have it on a sort of relative value, and we have it against some of the Swedish banks, which we think are very exposed to a decrease or softening of the mortgage market. And on the bond side, within the bond are probably on the right path for eventually being upgraded to investment grade. We think the bonds are very cheap, and they're also quite idiosyncratic, not really linked to a lot of the other banking dynamics that we see in Europe. And technically, it's not really a bank; it's more like a finance company in probably the hottest sector that we think was going to be there for the next 2 or 3 years, at least, given the pressure from the regulator on NPL disposals. It's been a very profitable position for us. We still like them. It's one of the things that also add quite a bit of diversification to the book in terms of being Europe, far away from the most market cap heavy weights of core Europe or periphery. The last trade is at page number 15, is the short UK. It's been probably the most painful single trade on the year. Credit default swap are effectively been compressing on pretty much on France level. We have that position. We like it. We think politically the position is much more supportive of our stance. Theresa May has been weakening increasingly over the last few months. We think at the end of the day, Brexit is going to be decided by Germany. So obviously it is a horrible case for the UK, which is when Germany decide to import the finance industry and decide that them or France want the finance industry, in which case it will be a very hard Brexit, and it will be like Greece style. So they will keep on negotiate until there is no negotiation anymore. And they will drag it on and on and on, but it will be a very hard Brexit. Now, excluding that, which would be probably the most favorable event for us, which would be the best case scenario, if I look at the most realistic outcome right now, at the end of the day, UK will be offered a deal. UK has no ability to ride the deal. It's literally going to be Germany deciding what to offer in the end. Theresa May will go back with that deal, and I think it will not be enough for the Tory, either the most Brexit prone or the least Brexit prone. So eventually Theresa May will go into a political crisis, and there is a decent chance Labour will take that to push for election. The election will then be possibly between a Labour in favor of soft Brexit or a Tory split or not split in favor of a harder Brexit. So basically you're either left with soft Brexit but a very hardcore Labour in power, or a hard Brexit or Tory party coming in and having the same kind of disruptive policies we've seen for the last year. Now, to put this in context from a fundamental point of view, the debt GDP of UK is 90%. They have a structural deficit which is not going down, and the GDP growth next year is definitely projected to be underperforming Europe quite a bit. We had, from a macro point of view, the sort of the positive benefit of both the fear of increased trade regulation and the lower currency. They've been effectively priced up front and front-loaded for UK. And that's something that's been surprising a lot of economists, although, frankly, it is relatively kind of textbook macroeconomics. And the economic picture has been brighter, and I think politically eventually Carney was effectively forced to backtrack on his original comment on Brexit being a disaster, and even to show that by raising rates. We think UK is the most leveraged economy out there. We think there is a big issue, which is is going to be consumer finance and mortgage finance in UK, especially if Europe move rates and US keeps on with their tax reform and the rates and the Fed policy. I think UK will be hard pressed to move rates, especially if sterling is under much more pressure and inflation is coming in. That could really trigger some pretty horrific dynamics for a very leveraged sectors. So, like I said, I do not think that is unforeseeable to have a situation where the main concern of the market is going to move from MPL in periphery over the next year to consumer mortgage finance in the Nordic countries starting from UK. That position, we kept it. We just marked it down. We took the losses, and unfortunately, we had to share it with our investors. But it's one position that I think is really maturing much better than our expectation because the political landscape is way worse than what it was before. It's something we're monitoring very, very closely. We see an increasing amount of similarities in the negotiation with UK than the negotiation we've seen between the Eurobloc and Merkel specifically and Greece after their referendum on the OE to the European Monetary Union. So obviously we are sticking to it. Away from that, the last one, we spoke at Lanza about it at the beginning. Short fixed income in core Europe. It's just simply the end of an era that lasted 40 years. I don't think there is much to discuss about this whole concept of structural deflation, all the rest. Those may very well be there, but job market eventually get to a point where there is a competency issue and the Phillips curve start kicking in. The commodity complex is definitely much stronger than anyone expected 6 or 12 months ago, and that's without even considering, Saudi Arabia geopolitical risk, Turkey geopolitical risk, or Venezuela. And obviously that could really tip the balance of oil supply and demand very, very meaningfully. Like I said before, for us, Europe is a case of corporate governance rules changing. Is the structural change which matters. The rules in Europe are changing. So ECB does not need to be there. And ECB, the new ECB next 2 years, will not be a Draghi-centric ECB. And I doubt they will find another man of the caliber of Draghi being able to effectively create political compromise across a variety of very difficult stakeholders. I think Europe simply is going to create a new set of rules, and those are going to be the rules, and they are not government bond friendly. So we do expect that to move. We expect the gap between US and Europe to eventually close. We think US is a matter of life or death for the Republican Party to pass something. It may not be this side of the year. It may be beginning of next year. We think the lobbying effort, once they go to the conference moment between Senate and Congress after Thanksgiving, assuming the Senate passes it, the lobbying effort will be massive. So our expectation is that what will come out of that, it will probably be very much tax cutting and expansion rather than tax reform, because nobody wants to lose any money. And we do believe in the lobbying ability in U.S. We also think there may be some more spending in Europe. It may even come from Germany to kind of create the coalition that is needed now to form the new government. But overall, I think there is more fiscal expansion coming up. We do see it via anecdotes or via like data evidence. We see a lot of activity. So we think that trade is the trade of probably of the last 50 years, and be positioned for that is not very painful. If you look at that, we've been trying to be short many times, made some money, we lost some money. We've been very opportunistic, but we are ready to be really meaningful on that trade because we see the fundamentals behind it just compelling. Now, we have developed, as you know, our quite a bit of software and artificial intelligence inside the business over the last few years. We also bought a company specialized in intelligence about social media. We use all those systematic signals to help us finding the timing and the sizing of those positions to give us a good input. But at the end of the day, our view is fundamental, and the fundamentals are becoming really, really compelling. And as I said many times to most of our investors, do not be surprised if we come next year in the first half of the year and we have an inflation overshoot. And at that point, ECB has not much room to maneuver. They may accelerate the tapering, and I don't think this market is even considering that opportunity. So the kind of opportunity, and I'll conclude with this, I mean, the kind of opportunity we see is very, very rich, is very, very attractive across. I think the macro side is amazing, simply amazing. On the banks and corporate, I think there is so many trends that are incredible. We see basically two parallel processes. Yeah, one is the macro kind of resurgence of rates, which is a matter of time. But secondly, and much more important for us, because we are credit guys, we do see a lot of negative dynamics developing in very, very levered sectors, industrial sector, overweight sector for the credit market. And that's where we think we're going to find a lot of opportunities, and there is nothing central banks can do to stop or artificially change that, because the speed at which the change is happening now is accelerating. And so that is one source of opportunity, which is different in a way, sort of unrelated to macro, but they could actually become compounded by the macro if rates are moving. With this, I close, and obviously we're available for any Q&A.
Thank you, Filippo.
As a reminder, if you wish to register for a question, please press star and 1 on your telephone.
So, okay, no question. We are the marketing team is always at your disposal. If you have any question after the conference call, you can send us an email, and also Filippo is always at your disposal. So thank you so much for your time. Thank you, Filippo, and see you soon in London.
Thank you very much. And if anyone has got follow-up questions, you can reach out to Abby or myself, and we're always available for follow-up or a more in-depth conversation. Thank you very much.
Thank you.